Qualified small business income is the largest deduction for most business owners, yet most business owners are missing out on how to maximize this. In fact, if you think about the typical advice, it's pay yourself the lowest amount in salary and take the rest as distributions. That saves you money in taxes, right? Well, what if I told you that's actually wrong? And the reality is, in this video, I'm going to walk you through a side-by-side of an entrepreneur. And by the end of it, you're going to understand what you should be thinking about paying yourself in salary so you too can maximize the largest deduction available to you, qualified small business income. Hey everyone, if we haven't met before, my name is Jacob Turner. I'm a former Major League Baseball player and the co-founder of Moment Private Wealth, a financial planning firm that specifically helps athletes and entrepreneurs build and protect wealth. And QBI, this qualified small business income, is something that we help all of our clients with. If you're new around here and you're an entrepreneur and you're a business owner and you want to get smarter with your money, make sure you subscribe because I'm always posting videos that are specific to you and your situation. Okay, so what is QBI? QBI, in really simple terms, is just the net profit from the business. Think about it after you've paid all the wages, all the expenses come out, your qualified business income is really what's left over. Think about it like the net profit. So who does it apply to? It applies to everybody that's a pass-through entity. So essentially everybody that's not a C-Corp, which is most of you small business owners out there, sole props, LLCs, S-Corps, partnerships, you can all get qualified small business income deduction. So how does it work? Well, said simply, it works like this. You either get a 20% deduction on your entire small business income, or you get a 50% deduction on all applicable W-2 wages. Now you might be thinking, how do I understand which one I get and how do I maximize it? Well, take a look at this flow chart I built. It all starts with what is our filing status? And we're just going to use the married filing jointly side, but you can use the single and the head of household side as well. They work the same way. On the married filing jointly side, you can see if our taxable income is below $394,600, we simply get a 20% deduction. Easy enough. But if it's above that, what happens? Well, you can see down here, if our income is between that and $494,600, we get a phased-in deduction. Okay, but what happens if it's over that? So if you're over $500,000, now what happens? Well, number one, you have to not be an SSTB to get any deduction. And SSTB, real briefly, just means you're a specialized service business, like me, a financial advisor. Let's say you're not an SSTB, which most business owners aren't. Now you have to determine you're going to get the lesser of either 20% of your qualified business income or 50% of your W-2 wages, but you're going to get the lesser of. Or said another way, the government's going to give you the worst of those two deductions. And this, my friends, is where most business owners fall in the trap of paying themselves a low salary only to not maximize QBI, which is a far bigger benefit than saving a few bucks on payroll taxes. Now, I want to walk through what this exact scenario looks like. So I'm going to show you some specific numbers. And remember, I promise you by the end of this video, I'm going to show you how you too can maximize small business income. Now, as I'm walking through this, if you want help doing this is something that our team at Moment Private Wealth helps with. You can click the link in my bio. You can schedule a call with our team and see if you are a good fit to work with our team. Back to QBI. Now that we understand, if we're making a lot of money, married filing jointly, let's just say we're making more than $500,000 a year, because that's really what it ends up being. We're either going to get the lesser of 20% of our qualified small business income or 50% of our W-2 wages. So you might still not be grasping why this matters so much or how to maximize it. So let me break it down in a specific scenario. Let's use an example. Jim, he's a business owner. He's making $1 million in taxable income this year. He's paying himself a $150,000 salary and he's taking $850,000 as distributions. So you might be thinking that's great. He's saving himself money by payroll taxes being a little bit lower and he's taking the rest of the money in distributions. Well, on the surface, it's a good plan, but here's what he's missing. On those deductions, he'd be getting a $75,000 deduction on his $150,000 salary, which is 50% of his W-2 wages, or he'd be getting a $170,000 deduction on his $850,000 in qualified business income or profits. Remember, you get the lesser of the two when you start making a lot of money. So for Jim in his scenario, he gets a $75,000 deduction. Still a great deduction, but he's missing out on a potentially much, much larger deduction. So let's consider if we reworked his salary and we start to even out his salary plus his distributions, what would he be at then? And a rule that I like to use is something called the 2/7 rule. If you take your net profit, you divide it by 7, and then you multiply it by 2, it's going to give you a number that you understand you need to get close to that number in total W-2 wages to maximize your QBI benefit. So let's take a look at this rule for Jim. Instead of paying ourselves a $150,000 salary, we bump our salary up to $285,000. Yes, we pay a little bit more in payroll taxes, but now 50% of our W-2 wages is $285,000. is $142,500. And now what do we have left over in our QBI, our qualified business income? Remember, it's essentially our net profits after we pay ourselves our salary, and that would leave us $715,000 in net profit or QBI, which means if we took 20% of that number, we'd be at $143,000. Now, $142,500 on the salary, $143,000 deduction on the QBI. You see how close those numbers are? And that's ultimately what we're trying to get to. We're trying to really balance those numbers out so they're very close. Because if you're out there and you're a small business owner and you're a pass-through entity like most small business owners out there, and you're making more and more income, much like our clients are every single year, that means we really need to make sure we're maximizing qualified business income deduction. And what I just showed you is the difference between a $75,000 total deduction if we paid ourselves $150,000 in salary, or a $142,500 deduction if we use the 2/7 rule and we maximize our QBI deduction, and we got an extra deduction of $67,500. So on a $67,500 deduction, if we're in the 37% tax bracket, that means it saves us almost $25,000 this year in taxes alone. Jim is a happy man. But the reality is, what I see time and time again is when clients come into us, they're not maximizing QBI. They're paying themselves a low salary, thinking that they're saving money in payroll taxes, which they are. But again, they're stepping over dollars and they're picking up pennies. We have to be forward looking. We have to be thinking about how can we maximize this number. So if you're a business owner out there and you're starting to make more and more money, hundreds of thousands of dollars a year or more in net profit, you too need to understand how to maximize qualified business income deduction. In fact, this is just the tip of the iceberg. There's all other kinds of strategies we can do to potentially lower our income to put us in the other brackets of QBI like I talked about. But for those making lots of money, you need to make sure you're using the 2/7 rule. Take your net profit, divide it by 7, multiply it by 2. That needs to be roughly your applicable W-2 wages. If you can get to that number, you can be very close to be able to maximize your QBI benefit and maximize what you're paying yourselves in salary, so you too are getting a bigger tax deduction. As always, my goal is to help you get smarter with your money, and that includes not leaving the IRS a tip. Until next time, my friends.